button, put on the mic. Good evening, everybody. Okay, just making sure that you all can hear me. We shall wait for everybody to come in. Okay, if you can hear me, please say hello to Mr. Lu and hit the like. Okay, yeah. We haven't done a live stream for quite some time. I know I'm behind time on my live stream, but I try to promise everybody to do one live stream a week. I used to do it every day, but live stream takes up number one, a lot of time, and number two is a lot of people cannot take the length of the live stream, which usually stretches from anything between half an hour to 45 minutes. So yes, Chai Ling, Yang Chun, good to see you. Yes. Okay, Pauline, good to see you too. Okay, who else is coming in? Please say hi to me. And remember, hi, please give a like. EH, good to see you too. Long time no see. Singapore Chinese, Brenda, good to see you. Sam, good to see you too. Lisa, good to see you too. Okay, Chi Ming, good to see you too. Okay, Desmond, good to see you. Okay, Brian, good to see you too. Okay, will you come in all, please give a like. Okay, Yuan Feng, good to see you too. Okay, stay right. Okay, I'll try to make this not very long. Okay, but I got help needed, so I decided to come on live to explain. This one cannot just do a video. This one a bit interactive, so I kind of need some help. Okay, that's why I thought I'd do a live. This topic is quite interesting. Okay, as you come in, all please all say hello to me so that I know you guys are there. Okay, LM, good to see you. Derek. Okay. Okay, Charlie, yes, B is suffering a pretty bad dose of stomach food poisoning, and her stomach is having very bad cramps. So we skip. Oh, thank you. She's having a bad stomach cramp. I give her 2 doses of the Yaqi Chinese medicine. Anybody know this medicine? 藿香正气水. It's alcoholic based, tastes terrible, but it's very potent. So she's resting right now. So now that's why I take such a long time to come on live. Okay, usually I take an earlier time if I can. Okay, yes, long time no see there. Thanks for watching. I actually got a microphone here. How's my microphone doing? Is the sound okay? And this is my replacement microphone. I've been trying it. I think it's working fine. Hope that this is good. And I bought this. Yeah. All right. Good. Okay. All right. Good. Very good. Okay. I'm gonna start with my topic. Let me. Okay, I'm gonna start my topic right now. Okay, thanks everybody for coming in. Now, recently, there is a lot of people who took me up for a fight. Okay, meaning that actually I don't really want to fight. You know, 吃饱太心空, right? I don't really want to fight. I usually, when I talk about my finance theory or whatever, it's biased. No doubt about that. It's biased. And I've intended it provocative. And the titles are provocative. Okay. And everybody take it, if everybody take it seriously, then, you know, you get upset, whatever, right? So the titles are, are meant to be provocative and things like that. But frankly speaking, you know, I've always said this, right? Many roads leads to Rome. Okay, many roads leads to Rome, and my way to wealth may not be the only way to lead to wealth. I've adopted a CPF first strategy, or CPF as an anchor pillar. Doesn't mean that people can have to do it this way, right? So I think, you know, and then I layer up with S&P 500, NASDAQ, okay? And above that, you know, it's up to you. I've layered with businesses and things like that. And there are some people who do it through dividend investing. Some people do it through crypto. Some people do it through properties. Some people do it through the same thing, but through dollar cost averaging. I like crash buying, you know. They call it another variant of it is lump investment. Okay, but there are lots of ways that leads to Rome. Basically, what I'm sharing is why I feel that mine is suitable for myself, and why I highlight I'm not picking other things. You know, in my view, dividend investing is bad, but some people think that, you know, by me saying that, you know, gets them very emotional. I don't see why people should get so emotional about dividend about a different view of investment. Sorry, not just dividend investing. Okay, so when I try to clarify myself with some people, and some people get very upset, right? And I said before, there's a gentleman called Patrick Teo. He's a great investor. He believes a lot in dividend investing, but he came out with this topic called "work till you die," right? And basically, I'm in line with him. Work till if you work in a job that you're passionate about, then you should work until as long as you could. However, people get upset with him. Very emotional topic, right? And it got so emotional that he left the 1965 group. And some people left 1965 group. Why get so emotional, right? Why get so emotional? Please, okay? Today I'm going to talk about, I think, a real comparison, right? All these nuances between dividend investing, growth investing, indexing investing, dollar cost averaging versus lump. These are, superficially different. Fundamentally, is all in a pool of equities. I think the real debate that we always want to have is equities versus properties. Okay. Now, someone will say, why, Mr. Lu? Why do you have to have choose between the two? Why can't you do both, right? And in a nutshell, I think that's what we should do. We should diversify everything, but unfortunately, there's a lot of people who are binary in their mind. They have to choose one, not both, for a different reason. Some are very concerned. They just don't have enough money to do both. And that's fair. Not everybody are high income earners whatsoever. And if they only have limited resource, they have to pick one, then which one should you pick? Some people, it's basically a level of comfort, right? They're only comfortable with one, don't know anything the other. I have a close relative that knows shit about no nuts about equities. So, but he's a big-time investor in land, okay, and a big-time investor in land in not in Singapore, in foreign countries. And he made a hell of money from it, like gazillion, like hell of money. And that's what you're good at, and that's fine, right? Some people say I bury money in my backyard. Okay, at least you have a backyard, not so bad, right? Yeah. But let's try to be a bit more. Let's try a bit more academic in this, right? Today, I'm gonna give the backdrop of how I think it should be. I want you all to be interactive with me to see how this can be improved. And I even ask for volunteers who are quantitative, know how to use Excel, to see whether you can come up with something, okay? And I'll use that your spreadsheet to discuss with the public, because number one, I got no time, okay, to work out. And number two, my Excel skills are pretty dumb, pretty lousy nowadays. But I'll give you the principle of how I think it should be done, okay? And I give you I may not have done the Excel, but my intuitive calculations will come out with an answer. So if you bear with me, okay? So this debate comes out in the 1865 group, actually, okay? And for those people who are interested, please join our 1865 group Telegram channel. The link is Lu1M65. Just search Lu1M65, and there are 30,000 people with a lot of experts there. We all share. It's a very noisy group because it's a lot of people. But I forbidden trash talk. Okay, so you won't see like hardware zone, that kind of trash talk, right? So anyway, let's think how it. So initially, someone say if you put $1 million into property and $1 million in equity, which one will win, right? So you put $1 million in equity, let's say put $1 million in equity in 30 years time, right, or 30 years time. You will compound at 8% growth rate, right? Then you will become some phenomenal number. 1 million will become 10 million for sure. Okay, that kind of number. And if you put $1 million into property, okay, and buy a property at $1 million, pay all in cash, the million property will turn out $3 million, in or $4 million in 30 years, something like that. So someone will conclude that, therefore equities win, right? But the world is not so straightforward. I'm also aware of that. The world is not so straightforward, okay? There comes the element called leverage. In short, mortgage loans. Who on earth will put one? Okay, so I then think of the scenario, and this is not the right scenario, okay? Okay, in equities, most people will not leverage. So you dump $1 million in equity and let it compound. 30 years at 8%, it become 10 million. But property, you will leverage, right? So if I have $1 million, most likely I'll slap $1 million in and buy a $6 million property, or maybe $3-4 million property. And then then the 3-4 million property will become, in 20-30 years time, will become, will go up by 3 times, will become 10 million. So both more or less the same, okay? So both more or less the same, right? So that's how things work. But actually, that's not true also. That's not true. You cannot calculate this way, right? Because when you whack let's say if you buy a $3 million house and you put in $1 million as your down payment, every month you got to pay monthly mortgage payment, right? So by the time you paid up, in current interest rate environment, have you tried, if you paid up to 30 years, how much will you pay? Someone can do a calculation for me. I don't know how to calculate. This is too difficult for me, okay? But if you calculate in this kind of current interest rate environment, which I don't think will last forever, but let's say instead of the 3-4%, let's say it's 2.5-3%, right? Something like that. No, now it's 3-4% or 4%, some crazy number. But let's say it's 3% or 2.5-3%. How much will it have paid in 30 years? Rough calculation, you at least paid double or triple. Then you should assume that you have done that same amount of money in equity for dollar cost averaging, right? Every year you do dollar cost averaging up. Okay, now it's 3.38, Yuan Feng said, okay? 3.8. So maybe in the long term, maybe 3%, long term 3%. Then you compare you basically it's a comparison of $1 million. Then every year you add in, I don't know how much is the money mortgage, maybe money mortgage, let's say for $1 million, someone calculate for me $1 million loan, $1 million loan for 30 years. How much is the monthly mortgage? Okay, $1 million loan for sorry, not $1 million. You're borrowing $2 million because you're gonna borrow $2 million, right? Suppose you invest in $1 million and then you got $2 million of loan. So if a $2 million loan, every month how much you pay monthly mortgage for, let's say 30 years, okay? Let's say, I don't know what the number is, let's say it's $5,000, okay? Then you must factor in the $5,000 dollar cost averaging all the way for the same 30 years. Then it's equal, right? Okay? Then this one will grow at 8%, this one maybe grow, at 3%, right? So, no, I'm not trashing, don't get so sensitive. You see, I always tell everybody, stop being so sensitive and emotional about investment. You need to be level-headed, right? The best investor got no emotions, right? Whenever I see emotional topic of these people, loser. So you gotta be very, very unbiased about your emotions, right? You can be biased towards a certain thing, but when other people are saying, you should hear them out and say, whatsoever, right? Yeah. So, but anyway, let's go back, right? Ignore all the rest of the thing. Yeah, best investors manage their emotions, right? So, and then you put both in, okay? So here in property, you put $1 million to leverage up to $3 million house, right? This $3 million house will become maybe $10 million in 30 years. And this one is $1 million, okay? And then you dollar cost averaging based on the monthly mortgage that you have done here and go up all the way for 30 years. And then you compare the returns, okay? Now, someone said, but Mr. Lu, you got rental, Yeah, you got rental for this one. Here you got no rental, but in theory, you got some dividends, not as much, okay? S&P 500, the dividends is, I don't know, 1% or 2%. Okay, but if you are invested in property, that has dividends, okay, sorry, if you have property as rental, most likely it's a second house. Then you got to factor in ABSD, right? And most people will agree with me, once you factor in ABSD, then there's no comparison. This is not beer. This is barley tea. Okay, barley tea. I don't drink. I don't touch alcohol. Very, very little. Very, very little. almost never touch. Okay, so I think the fair comparison is a $1 million investment or 100. You can lower it to 100,000. It doesn't matter. Let's say $1 million in equities and $1 million as a down payment in a $3 million house, something like that. Okay, and then this will be an owner-occupied house, because once you factor ABSD, I don't know what's the ABSD right now. In a $3 million house, you destroy the entire economics of it. That's what I understand from property investors. So it will be an owner-occupied house, and then reasonably, at a point of time when you retire, then you got to downgrade, right? You got to downgrade, or else how you realize the value. Let's say you downgrade to a smaller house, okay, maybe at half the value, or maybe 1/3 the value, I don't know, okay. Yeah, then you can realize the chunk ma. But here you can recognize the whole amount. What I'm trying to tell you is, do you realize how difficult the comparison is? So for everybody who say that, oh, property is a great investment, equity is a shit investment, or equity is a good investment, property is a shit investment, do you realize how difficult it is, the comparison? Okay, it's not easy to compare. Yeah, it's very difficult to compare. So in short, you cannot say for sure that property is a damn good investment. Okay, but neither can you say that that equity will champion over property. Then it goes down to my original proposition that you should do both. Okay, spread out. Okay, and do both. Then you have got diversification, ma. But if you were to whack into one, good for you, up to you. I don't like it, and I advise people not to do it. But if you want to choose one, can. But you are in no position to easily compare the difference. You actually need spreadsheet, do it. And I really encourage everybody who, anybody who is up to the challenge and who are very quantitative in nature, to help me work out the spreadsheet of it, okay? And then make some assumptions on both sides. So under certain circumstances, this will make more money. My gut feel, if you assume a $1 million here, $1 million here, and this one will grow by 3 times, and this one will grow by 10 times in 30 years, okay? But this is a leverage and this is unleveraged. But the amount that you pay as a monthly mortgage, you do a dollar cost averaging here every year, okay? My gut feel is equities will beat property by a little, not like a lot, by a little. But I need people with Excel skills to be able to do this. Maybe even need a bit of programming to be able to do it. I don't know how to do it. Okay, maybe I can get Emily, who knows programming, to do it. She's a mathematical science major in NTU, so maybe she can help me. Okay, but my gut feel is that in this scenario, then now it becomes the soft factor right now, right? Soft factor, okay? And what is the soft factor? The soft factor would have been, on one side, okay, a property you need to consider when you downgrade what kind of house, right? Okay. Number two is that in property, you have aesthetic, you have aesthetic enjoyment, right? You can see the house, you can enjoy the house, you can stay inside. You, in theory, enjoy free rent, okay, free rent in that sense, where if it's your own occupied house, but in the case of equity, you don't enjoy anything, you just see a piece of statement and just see from it. So this kind of soft factor is very difficult, right? Property, you can touch, can feel, you can touch, can feel, you feel good, right? But in equity, you cannot touch anything, so you may not feel good. And so on, right? So it comes down, and then the other one is familiarity. Which one you may more? A lot of people really want something to touch, right? Then of course there's a question of, what if you can do decoupling? Then ABSD doesn't come in, then rental come in, and all kind of things. But let's assume we just do owner-occupied house versus, equity investment first. Right? So this one is the best comparison. And then property, rightfully, Peace actually said this: property is illiquid. If you want to realize it, you forever, right? I'm not saying forever. Maybe how much does it take now to realize to sell a house? Let's say the length of time right now. I think Dragon Tan is talking about, I don't know, 3 to 5 months right now. A very long time. Last time you just launched itself already. Now a lot more difficult. Okay, but in then after you sell the house, you take about 3 months or so, 3 to 4 months or so for the property to realize. My Malaysia house seems to take forever to transact. Okay, until now I still haven't got a key yet. So property is very illiquid. In case there's a fire, they call it in Chinese. I don't know if you heard of this phrase. 远水救不了近火, which basically means that far water cannot put out the immediate fire, right? But in terms of equity, you sell it in, I don't know, 2 days or 3 days, you get money already, something like that. Okay, so there are these kind of soft factor now in comparison, right? So it is not so easy to compare. It's not so easy to compare. I haven't done the computations. I wish someone could help me. Anybody could help me up to a challenge, get a little prize from me, right? But I would be very interested to know the outcome. My gut feel, intuitive sense, if you factor that scenario, okay, then you will get an outcome. Now, of course, there are scenarios where this is it Benjamin? Yeah, Benjamin say that what if you flip property? Every 10 years you flip, flip. Possible, right? But it's then there are endless scenario, right? As endless scenario. Then if you flip there, could there be a scenario that you could it's like stock picking already, right? On this scenario, then could you stock pick on the other side and get better returns, right? Very difficult outcome. So as you can see, there is no apple to apple comparison, and basically there's just no apple to apple comparison in this whole scenario. I would strongly believe that you should have both. Now, Benjamin said that, Mr. Lu, we cannot use owner-occupied house versus equities. Of course you can, right? Because, I use a $1 million scenario, but you could lower it to 100,000. So both at start 100,000, okay, or 200,000. And then in short, this guy has, the owner-occupied house has the equity guy has a house by himself. And then you kind of level up, right? But investment property, you need ABSD, right? But the minute you have ABSD, okay, some people tell me that, and a good property investor tell me, what is ABSD? Destroy the whole property investment. So it's so let's work out the scenarios, and I'm happy to have a challenge and ideas how we can improve this comparison. I think the most likely conclusion is that there is almost no apple to apple comparison. Okay, so in that sense, when we compare property and equities, since there's no comparison, maybe we should all shut up and just say that you either do both, okay, or stop flaming each other in that sense, right? Not stop flaming each other, and have a well diversified portfolio, right? So yeah, that's my thought. Let's hear some views. Okay, let's hear some views. Okay. How to trade when there's SSD and ABSD? Exactly. So in short, you cannot have a second property. So you cannot compare a second property versus equities, right? Okay. I'm not even factoring the risk. I'm not even factoring the risk of volatility of both sides. I'm not even factoring the risk of, let's say you buy a condo, and in your house, someone on upstairs jump, and then your house forever now not really got quick, but people frightened. Then the whole block now all lost value. Have I seen this kind of case? I rumored to have heard this kind of case. I don't know how true it is. So that's sway, right? Yeah. So I take away this kind of it's like invest in S&P 500. But let's say S&P 500 just jibaboom, US gonna bombed by nuclear bomb and all die in this kind. Let's ignore this kind of extreme circumstances. Just normal growth, okay, normal growth. If I make property make money in property is the best. Next one, may I make money in equity? Equity is the best. Exactly, right? A lot of people will say that, yeah. Yeah, lor. 客话如客言. Sorry, don't understand. All roads lead to Rome? No point comparing versus property, okay? So that's where I'm coming to the conclusion that it's difficult to compare the two, okay? And I think I don't even think there's a basis of comparison, right? So it's really down to what's your level of comfort, your skills, your inclination, and whatsoever, right? So I think that's a fair comparison. Okay. If we invest in stock that give more than 20% RO return on equity, then it is better investment than property comparing apple without leverage. But the property investors, all of them will tell you cannot do that, Mr. Lu, you idiot. They say that before. Property investment always come with leverage, all right? So then there's no fair way of comparison, okay? But Mr. Lu way of stock invest also very long-term type. You cannot sell stocks as when you make a loss right away. So I don't understand what you're saying. It's like comparing iPhone versus Android. Excuse me, personal preference bias. Okay, fair. Exactly. I like both and building both. Both are great for my portfolio and part of my plan of retirement. I agree with you. Okay. Property without leverage is waste time. Okay, that's exactly what I mean. I also agree that it's very difficult to consider property investment without leverage. Support your view, Mr. Lu. Just do what you're comfortable with, same as property. Stocks also have leverage and options to the moon. Die also fast. Most people, including myself, will try not to touch leverage. I do have leverage equities, okay, but that's a very small portfolio of it, and that's more for play money, okay. Anyone here with macro and friends in property investment? No, what is macro and friends? I don't know. Okay. Okay. Yeah. I'm trying to look at all the comments. Anyone that have any more comments on this? How to compare property and equity, Ichi finger portfolio? There's a lot of science to it. They have to run algorithms and things like that. It's actually quite young. Then Benjamin and Emily helping me. They are the more quantitative people. So I have a portfolio that we use algorithms to trade. Okay, that portfolio grew very fast and crashed very fast. The one movements are in the 6 digits, sometimes in a week or so. Okay, Marco and friends. So I don't know what's that before. Okay, so but anyway, let's leave that aside. So the long conclusion of it is that when you compare two investment strategy, you have to have a basis of comparison. But unfortunately, we realize that the basis of comparison may not even exist. Okay, so therefore it goes down now to level of comfort, and maybe diversification is better. Okay, right? And I also assume that if you bought a house, let's say 20-30 years ago versus you buy a house now, the environment is very different. Okay, the environment is very different. And same for if you invest in equities, 20-30 years ago to now, the environment is very different. If you invest 20-30 years ago, you cannot this 10-year date zone, and this one property, you also cannot a 10-year date, about 5-10 years date zone in the early 2000s or something like that, or 2010 or something like that. After 2008, there was quite a dead period as well. So it's difficult to compare like to like. It's a lot of matter. But however, the bottom line I'm trying to tell you is that if you were to compare as much as possible, force a like to like, I suspect that the difference is incremental. Okay, then it goes down to soft factors. Here if you have a huge mortgage, you don't dare to change job. You take less job risk. Okay, here you get a house. You feel more comfortable. Here equities, whatever, doesn't really matter, right? So there's this difference. Yeah. In Singapore context, the risk versus returns reward in property investment, in my honest opinion, is quite good. It's hard for property to drop down to zero. What is important is holding power of property. The same can be said for the S&P 500 or NASDAQ, right? it's the same, right? The risk of it going down zero is very low as well, right? Almost non-existent, I would say. Okay, but you also need to stomach. So it's the same, right? It's the same. Okay. Okay. Buy property investment, you can start small, unlike stock investment. Property, you cannot start small. The selection risk is you can't start small. Okay, yeah, that you are right. Okay, you cannot do a property investment small. Stock market you can. So the selection risk of property is very, very high. Very, very high, right? Okay. Excuse me. Excuse me. Stock investment got PE expansion, but property don't have. Okay. What is PE investment? Property or private equity investment. Okay. If you invest in 99 property and compare equity, my thought is equity will be better. Okay. There's also a risk of property decay, right? But of course, people say that Singapore where got decay, everything go up. I don't quite deny that. Okay, at least in the current market right now. Yeah, price earning expansion. Okay, property is all about leverage. No leverage, better go buy bond. No, yeah. 没完没了. Later, someone will start small in property and buy REITs. Okay, property a lot of tax when you buy and after you sell. Equity zero. Yes, when you buy property, there's a lot of tax. But after you sell, it depends when you sell and your HDB or whatsoever, and then you buy. Yeah, equity zero. That is true as well. So not so easy compare lah. Okay. Okay. I have a dilemma on this recently, whether upgrade property, invest in stocks. I had to calculate how much I need for retirement, then I decide which one is better. And what's your conclusion? I've decided it's better not to upgrade and just building CPF invest in stock. I would say that if you are a certain age already, try not to invest too much. Go something safer. Okay. Let's say at my age 50 years old already. How much can you tamba into investment? Right? Very difficult. If stocks not doing well can exit market faster than property, that is absolutely true, right? So you see there is liquidity in it. No, so I suspect the main difference will be in the soft factor. You need liquidity you get liquidity in exchange for illiquidity. You get to touch and feel things. You can haolian. People can see your house, there is a real value. Can see your house, you can see your condo, see your bungalow, see your whatever, and you can be proud of it. People cannot see your S&P fund. Even you got $1 gazillion in the S&P fund, you cannot waive your share cert, which nowadays don't even have share cert. And see, I got a lot of money, right? Here people see, wow, uliao, respect. Here cannot see, right? So this kind of soft factor does matter. Okay? All right, okay. All right, good. Okay, with this, I don't know, I just want to wrap up. I thought it's a very interesting discussion. Okay, if anybody could help me with this calculation of, I'll try to give you a little prize or something like that. I really will appreciate it. Okay, but if anybody help me with this calculation, and you can email me at luchengchuan@gmail.com and we can discuss over it. Okay, yeah. So thank you, and remember, hit like and subscribe, and I'll see you tomorrow. Thank you, and good night. Okay, good night, everybody. Okay, good night. Okay, answer some questions along the way. You have good night. 2012 bought a condo, down payment 300,000. Today profit after loan is about 1.2 million. Okay, 2012 now is so that's leverage play, right? Okay, that's 10 years. Yes, that's great. Okay, I'm just thinking. Okay. Now, what's your opinion? What's your opinion on low interest in RMB and high interest in US? Will US and RMB weaken to more than 10? What's the repercussion? It's hard to say whether China economy will recover or not. I think a lot of economies are now frightened about whether China will end up like Japan, 30 years recession. Exactly, MW. If you profit 1.2 million, where will you stay? Exactly. Again, it goes back to, unless it's a rent, this is a second property, right? So, what are you going to do with the 1.2 million, right? Okay, I think it's fair. All right, okay. So anyway, I'm mindful that it is it's very late already. But thank you everybody for joining us, and I'll see you tomorrow. Okay. Bye bye. Good night. Good night. Good night. Okay.